Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. While the hawkishness of Fed or the stance taken by Fed to fight inflation at all cost continues, there seems to be some dampness in the dollar strength narratives. We are seeing some cool off in the dollar index, which weakened against majors like euro and pound. While also in the Asian segment, we have observed something similar with CNH. On the Indian front, however, the preliminary trade deficit numbers came out yesterday with the deficit widening to USD 26.72 billion for the month of September. Morning, JK. How are you reading these numbers? While globally we are seeing some weakness in the dollar strength, India's trade deficit continues to be under pressure. What's your view on the rupee?
Yes, I'll come to the rupee later, but let me focus on the global events, which was significant yesterday. In fact, the first day of the quarter marked a remarkable session where an extremely bearish start amid worries about health of several institutions globally slowly petered out and positive news took over as the day grew. In fact, just two events of the month's first day. First of all, it was Chancellor of Exchequer in UK who had come and scrapped the 45% top rate of income tax cut that they had announced and the so-called mini budget. So the 45% top rate will remain. He issued a statement saying that the plan had become a distraction from the overriding mission to tackle challenges that are facing the economy. So obviously, pound and the money markets in UK rallied with the markets already caught quite short. 10-year gilts yield fell more than 12 bps. It might have also been led by political considerations that as it would have been almost impossible to get regulation passed by the House of Commons. But investors were definitely happy. The second event came when ISM's manufacturing survey in US was published, and the activity grew at its slowest pace in nearly 2.5 years in September as new orders contracted with high interest rates and cooling demand. So PMI dropped to 50.9, the lowest reading till May 20, from 52.8 in August. Expectation was 52.2. Indicating that companies are adjusting to lower future demand actually. Besides, the employment also contracted for the fourth time in the last 1 year, while the gauge of inflation at factory gate decelerated for the sixth straight month. So overall, it was a weak report from US, which added to perception that markets may be harboring about Fed having to slow down not too far into the future, but definitely it boosted the currencies, bond, and stocks. And before we go into the actual market movement, I should say that in what must be regarded as rarest of rare moves, United Nations said the Fed and central banks risk pushing global economy into recession if they keep raising rates, and warned that Fed further increasing rates can cause significant harm to the developing countries. The report of United Nations Conference on Trade and Development said measures including strategic price controls, windfall taxes, antitrust measures, and tighter regulations on commodity speculations were preferable compared to the interest rate hikes. So basically, they are saying that also address the supply side issues and interest rate hikes at this pace would harm the global economy. I'm not sure how the central banks react to their statement, but it definitely indicates a widespread resistance to further synchronize monetary tightening by global central banks. In fact, two Fed members, Williams and Bakin, continued to make hawkish statements, with the latter even saying to the effect that a strong dollar is not affecting US economy and their mandate is to help operate the US economy. So it's a very detached statement from what's happening in the world elsewhere. The data from US just added to the positive moves in the stocks, bond, and currency markets on the perception that Fed may be achieving a slowdown that they want. And US 2-year yields fell 15 basis points, then near by 25 basis points, and 30-year by 14 basis points. As for the stocks, Dow rallied 2.6%, S&P 2.59, and Nasdaq 2.27. In fact, the global index of stocks rose more than 2.5% in what must be termed as one of the biggest relief rallies. Importantly, what I am watching closely is the S&P 500, which again avoided closing below the 200-week moving average at 3590. It had closed on Friday, but it's bounced back strongly from that level. So one should think that it could have been an aberration, but the coming weeks will tell us whether it was actually so. And it was one of the market one market feeding the positive to another, as the fall in yields led to higher stocks, and then the positive risk sentiment from stock market then helped currencies also to stage a stronger recovery. In fact, dollar weakness was no more conspicuous than in the gold, which rallied more than 3%, and silver by a whopping nearly 10%. Dollar index itself fell by 1%, with pound making more than 2% gain from the low of the day. Euro held steady despite another weak PMI report from Eurozone due to the overall weakness of the dollar, while commodity currencies have made significant gains, particularly the New Zealand dollar and the Australian dollar, where the Australian Central Bank is expected to deliver a 0.5% rate hike today, New Zealand another 0.5% tomorrow. So from not surprising that they were rallied strongly from these lows, multi-month lows. We'll have two important releases today: August factory orders and the JOLTS data. Factory orders are expected to be down at 0.2%. Even the job openings are expected to decline on a month-on-month basis, but still enough for an extremely high ratio of openings to job seekers. Rupee, of course, had started on a weak note. Again, on the weekend, reports suggesting some institutions being in trouble. And although also the oil price, which had gone up on reported intention of OPEC to cut the output in the coming months. So the recent large sell-off by FI is also taking the flow into negative in September. That will also spoil the positive sentiment that is developing in the market. In fact, Indian stock markets also fell hard yesterday. Central Bank, of course, appeared at 8190 and stemmed further fall in the rupee. Of course, the overnight developments on the dollar index and the risk sentiment is supporting the rupee, which has now been trading around 8160 compared to around 8180 that it was trading at yesterday's close in Indian market. I have a tentative signs of a double top at 8190 with a neckline at 8115, and the break of the 8115 levels will definitely indicate more gains for the rupee. So my take on the development of the market is that there is an increasing concern about extremely tightening financial conditions and the dollar with a potential big damage to global economy, particularly the weaker ones. Some actions are showing that the authorities have an intention to reverse these tendencies. We have seen, in previous years, preemptive rate hikes, but rarely have we seen a preemptive pause in rate hike cycle because inflation is still ruling high. So are we going to see that in the days ahead? I think markets are hoping for it and are rallying on that basis. Let's hope the recovery stays on course. Meantime, wishing you all a happy Dashara. Thank you.
Thank you, JK. And what I got out of that was that Fed may be achieving the slowdown they want. That's the narrative which is going on, which we are seeing in the rally of risk assets. And even if we see the Fed watch tool, 1 week back, 75 basis hike for November meeting was at 72%, and now it's at 55%. So of course, market expecting some sort of slowdown. Thank you so much for listening. We wish everyone a very happy Dashera. Markets will be off tomorrow. We'll see you all on Thursday. Thank you.